All right, so today we're going to be looking at long-term liabilities. Let's put it in perspective of where we are, okay? We've done a lot this semester, and now it comes down to this. It's the fourth quarter, right? And that's pretty much what we have. But it's not going to be difficult because we've done everything we need to do to get to this point. So let's just kind of put in perspective where we are. We have, as usual, our balance sheet, which is our assets. And they're always going to equal our liabilities plus equity. Now, we just got through looking at things on this side. That would be accounts receivables and equipment, okay, property, plant, and equipment. Now, when we looked at receivables and equipment, we looked at those basically as one unit with different names. And that made it kind of easy for us to study. In the same way, we're going to look at liabilities and equity as one unit. Why do I say that? Let's just kind of go back over our debits and credits. And remember, a debit is just means left and credit just means right. It only matters when you put it down in terms of how it increases something. So how do we increase our assets? We do that through a debit, right? We increase our liabilities through a credit, and we increase our equity through a credit. So as you see, if we treat these the same, then we're basically going to have everything we need. We know everything we need now for this. It's just a matter of going in and getting new accounts. That's all it is. And it's not really a lot of new accounts, okay? So when we think about this right here, let's say we open up a business, going way back to the first part of the year. If we open up a business, we're probably going to put something in it, okay? And when we put something in it, obviously, let's just say we use cash, okay? Always pretty much have cash. So let's say we put some cash in our business. If I'm not mistaken, I think we had a restaurant and a gym, and there was something and an event place. Okay, those are the three jobs we had at first, the three businesses we had at first. So either way, we're going to put some cash in there, and of course, we know we would increase that asset cash with the debit, right? But we're also going to have something else. Now, when we put cash in the business, it's our cash, right? And we have to remember, we have to think about everything we do as us in our business. If we put cash in the business, is that our cash? We'll say yes, right? We don't owe anybody cash. So, do you think that this cash will go under liability? That's right, no, because we own it. And we express ownership in here in terms of equity. So, I'm going to write the name, and I'm going to write the T account first. It will go here under our equity. Now, what is the name that we will give this? Whenever we think about the word stock, stock simply means ownership, okay? So when you're talking about buying stock in a company, you're talking about buying ownership. Even if you're doing it in terms of a day trade, then for that little amount of time you have it, you have ownership in there. So we're looking at this and saying that we put some cash in our business and we're going to have ownership. And so I'm going to write two words, the last one first. We have stock in that company. Now, the ones that we look at the most is going to be common stock, but there will also be some called preferred stock, okay? This here will be the last thing that we'll work on. Not today, but this will be the last chapter that we cover. So is everybody okay with that first part first? Okay? Now, let's just say that I want to put in $100. I want to invest $70 cash, right? And so that means I have $70 of ownership, okay? But what if that's not enough? What if I need some more? Then what do? I don't have any more to give, so the only way I can get it is to get it from someone else. Now, here's the thing about stock. Look at it this way. It's your company. You invested cash in your company. That means you have 100% ownership. Do you agree? Now, if I sell some more stock, let's look at it this way. I started with 70. I need some more. So I need $30 more of cash. And it's okay, because we may need that. I can finance this in one of two ways. Now, if you issue stock, like I say, we talk about owning stock of the company, we talk about having ownership. If you choose to issue some stock to get it, then you're giving up part of your ownership, okay? Now, that could be a good thing. That could be a bad thing. It depends on who you are. If you have a certain skill set, but you don't have this skill set, you might think about partnering with somebody, okay? And so for that reason, you can have some of this come out of your equity. But for this purpose, I don't want to give away, I really don't want to give away anything. So, I think I'm going to give them equity of $1. That's pretty stingy, right? But that's all I want to give, because I don't want anybody to have any say-so in my business, right? But I still need $30, so where am I going to get it from? I think I'll go to the bank. And I'm going to sign something that means I'm going to pay them back, and I'm going to pay them back over time. And anytime we talk about something over time, we're talking about interest, okay? So I'm going to go to the bank, and I'm going to get me a liability. A loan, excuse me. And with that loan, the difference would be $29. So I'm going to get a long-term liability of $29 from the bank. So what do I have now? I still have assets of $100. Remember, I needed 100. I started with 70, but I had to get 30 from somewhere else. No matter how I get it, I still have $100, right? I invested 70 in my business, but then I gave up one small part of that business. So now I have 70. Now, let me say it this way. There is 71% ownership. Now, this is not my 71, but this is 70 of mine plus one that belongs to someone else. Either way, it falls under equity, but it's split out here. I know in our books we only see one type of ownership, but just understand that, look, it's all equity, but we know what we did. Believe me, if they didn't track what they did, then they would probably be giving away their whole business. So even though we don't see this, if you just pull up a set of financial statements, you're not going to see everybody who has equity in it. Remember, you got day traders, so they're in and out, in and out. Okay, so you're not going to see that. But regardless, you have equity of $71. Now, I also owe someone, and in total I have $29. So my business has $100 in assets, right? And it is financed 70% from me, 1% from somebody else, and 29% is owed to other people. That would be the bank in this case. We'll call it. It could be anybody, but we just call it the bank because we're used to it. Okay. So does that kind of help you in terms of where we are and what we're doing in this case? Because the perspective is always important. Whatever you do, think of it as your business, unless it says record both interests. If it says record both interests, then you have to think of it from both ways. Okay. So this is what we have in terms of our business. But if you work for the next company, you just start thinking like you are that company as well. But we're just thinking about us as entrepreneurs in this case right here, okay? Can we keep going? All right, so with this liability, I know that I said bank, and it's okay. I want to do it a little bit differently. In this case, I'm still going to have a long-term liability. But what I want to have is a bond payable. I want to change this to a bond payable. As you see, I can do that without changing this because it's all the same. Now, why do I have a bond payable? Let's go back because it's important we understand why we're doing this. Equity means that it is your ownership, right? You got cash because of what you invested in the business. We're clear on that part, right? Why did you get this loan? You got this loan in order to do what? Have some money for the business, right? So not any, but in the case what we're talking about, especially with bonds payable, the only reason you issue a bond is so that you can get some cash, right? That's the only reason you do it. In general, that they don't all work the same way. If I'm the person if I'm the bank that gives you the bond, I give you the bond, you pay me a little bit of interest as you go, and in the end, then you're going to pay back the whole thing, okay? So that's kind of just in general. But this is done so that you can raise money. If you didn't have this right here, if you didn't have the $29 here, you still need to find it from somewhere else. Maybe you're going to find a way to put more of your savings in here. Maybe you're going to go to your friends. But for the purpose of obviously the textbook here, we're going to consider that we're getting a bond payable there. Okay, so we're doing this in order to raise money. And so the journal entry will basically be that I'm going to debit cash. Let me split this into two right here because even though it's the same, it's going to make this journal entry a little bit easier. One is going to come from someone else, and 29 is going to come from here. So, the only thing I did here is I adjusted this from 30 to 29. So, we're going to debit cash, and all I'm doing is recording it in my books now. I'm just recording. Everything is happening, I'm just recording it. So, I'm going to debit cash for $29 if I get cash from a bond. I have a liability, okay? So I'm going to debit cash and I'm going to credit bonds payable. BP for bonds payable. That's my journal entry to record the cash that I received from my bond, okay? So just to kind of put that down here, this is not anything to do with liabilities, this is just a journal entry. I'm going to debit cash, I'm going to credit bond payable for the cash that I received from my business as a result of that, okay? So this may be a new journal entry for us, all right? But this is how I record the cash that I received as a loan in terms of bond payable. That's what we have right there, okay? Everybody good with that one? All right. Now we're going to have some different scenarios. And the scenarios are going to come about in terms of how we're going to gain this money, okay? So let's pull up I'm going to pull up a small example here. This example right here that I gave you, it will go very well with the question that says something like this. On such and such a date, a company issues a certain amount of money at a certain price over a certain amount of years. Let me put this up so you can see this one here. Your numbers may be a little bit different. That's why I don't want to use the numbers, but I want to understand the concept. Okay? In this problem right here, what we see is that, let me put it down so you can see it there. What we see is that the company is going to borrow some money, right? Now, it's going to say in this case it's borrowed $327,000 for the bond. So it's borrowing $327,000, and as you see, they're going to debit cash there, right? And they're going to credit bonds payable. How much is that for? Someone tell me, I'll write it right here. We'll just use those numbers. So we're going to go from this here to use the numbers in our problem. How much is that cash that they have there? Did that thing just move? Okay. $327,000 was like $327,000, okay? So this bond is worth $327,000. In this case, it has an 8% interest and a 10% bond. Right now, that doesn't mean anything to us, okay? Now, the reason it doesn't mean anything to us is because we're just preparing the issuance of the bond, okay? Now, when you see something that is done like this, and if it says they issued for $327,000 and you record for $327,000, this is called a bond issue at par. When you think about par, we think about something being even, right? And so in this case, it's just even at what it was issued at, okay? So this here, debit cash, credit bonds payable, when you see this type of issue, now a lot of times they're going to say it's issued at par, okay? And if they say that, then that's good. Or you may see something like this right here. This bond says that we're going to have to pay, that 8% is what's going to have to be paid, right? Now, it's called the amount of interest that's on the bond, okay? But that can be different. If I have a bond here, and a bond is nothing but a piece of paper that we're going to look at. So let's say this is a bond. It's not a dollar bill. It may say 8% interest on here, right? But that's what I say, 8% interest. Now, keep in mind, you can go down the street and possibly get that same amount for 6%, for 3%. Hopefully you don't get it for more than 8%, right? So depending on what the market rate is, that's everybody else, depending on what the market rate is, that's going to tell you if you're going to issue it at a discount or at a premium, okay? So that's what we're talking about. Discounts and premiums have to do with whether the bond, the amount on the paper, on the actual note there, is matching or not matching what is out there in the market, okay? So the market dictates whether we have a discount or a premium. You're going to see that come up in your homework problems. We're going to go over it a little bit more. But if it's issued at par, then it is even. That means that the rates on the bond rate match the rates what everybody else is doing, okay? So that's issuing a bond at par, all right? Now, just in general, if I turn around and sell this same one, then what am I doing? Excuse me. If I have to turn around on the date that I pay it back, when I pay it back, what am I doing? If I got it at par and I just pay it back, then I simply pay back what I borrowed and then I take off the bonds. So I basically reverse the entry, okay? So when we talk about bonds, we borrow the money, then we pay it back. And so that's just in general what we will do, okay? Now we're going to get into more, next time we get into more the premiums and the discounts, but this is just an overview to show us that all I'm doing is financing my business the same way I would do with a notes payable. Now, we know a little bit about notes payable, but notes payable can be another long-term liability that you will still increase with the credit. Okay, so that can be another long-term, and in general, those are the kind that we have. I have another one I want to tell you about, but any questions first? Everybody okay so far? Okay, now, this one, I'm not going to say it's tricky, it's just something we have to make sure we pay close attention to, okay? We're going to use, and we looked at it a little bit earlier in the year, but let's say, I'm going to erase this right here. Let's say that we purchased a house, right? And we purchased the house for this is mortgage payable. Mortgage payable. We purchased the house for how much? $400,000. That's what I was thinking. $400,000. Okay, good. So I don't want to pay it, but that's what I was thinking of. $400,000. So let's just say we don't put anything. We don't put anything on it. Okay. We're going to pay out cash, but we're going to have a. What I want to emphasize here, we're going to have a $400,000 house note. Okay. Now, what we paid off over anything over a year. 2 years, 3 years, 15, 10, 30, this will be a long-term liability, okay? So let's make sure we understand because it's gonna be a tweak, but it's important because we all have to go through this. You're renting a building out for your building, okay? And let's just say that you're buying it instead of renting it. You're gonna pay it over 5 years. Even if you have a long-term note that's not a mortgage payable, you're going to do it over 5 years, you're going to do it over 7 years. The thing is that it's not done, if it's in a long-term liability, if it's long-term, it's always more than a year. We agree on that, right? But what happens knowing that I have to pay back a little bit within a year? Am I going to wait to the end and pay back this whole $400,000? No. I'm going to pay back some of it as I go. So what I'm going to have to do is to take out, if I just got this right here, let's say I'm going to pay it off in 10 years, if I'm going to pay it off in 10 years and I'm going to pay out $40,000 this first year, okay? So on day one, January the 1st, if it's January the 1st, this will be my entry. Now I have to immediately reclassify part of that because if I'm going to pay $40,000 this year on it in 10 years, then this part, this is going to become a current portion. Current portion of my long-term liability. That is important that we make that distinction, okay? So even though I take it out January the 1st, I'm using January the 1st because it's easy enough to use. Even though I take it out January the 1st, yes, it's a $400,000 loan, but I have to show that I need to pay this year for a lot of different reasons. Number one, you need to prepare for it, right? If you see anything long-term, I'm thinking long-term, anytime after a year. That's just what I'm thinking, right? That's what you're going to be thinking. But if someone gives you something like that, you just say, well, hey, how much is this going to be due next year? Because, we'll get to the because in a second, but back to you, why you should know it. It's just good to know. But then, remember your current liabilities are usually paid out of your current assets, right? Current liabilities are usually paid out of your current assets. Take, for instance, your light bill. Light bill is going to be paid out of your current assets. We agree, right? But we have more than light bill that's current assets. So let's just say that I forget to reclassify this part as a current asset, right? Let's say I forget. And let's say I have current assets of $40,000 just to make it even. Let's say I have $40,000 of current assets and it's right here. But I forgot to reclassify this. Then what does that mean? It means that I really don't have enough to pay my bills. They come up in terms of for the mortgage. Now, chances are I may try to forego some of the others to pay my mortgage. I'm going to probably pay whichever one is most important to me, okay? But it's important that I reclassify that because I need to make sure I have enough cash on hand. Cash is a current liability, okay? Why is cash important? Because I have to quickly go and knock that out. So, mortgage payable. is a long-term liability. But you must reclassify the current portion of that. That way you can make sure that you have enough current assets, cash, receivables, inventory, supplies. Prepaid is not going to be related to that, but if it's a prepaid, you prepaid your insurance, you can get that money back. You know, you can pay your insurance up for 12 months. If something comes up where you change insurance companies, you're going to get your money back then, so you can get it back. That's why it's still classified as a current asset, because I can quickly turn it into cash. Okay, so let's make sure that we always reclassify the current portion of our long-term assets. Okay, of our long-term liabilities. All right, let's look at the next concept here. Well, first of all, any questions on that? Okay. All right, so let's look at a couple more scenarios right here. Let's look at the sales tax payable. Now, we're going to get to the easy ones, okay? We're going to take a little bit more time next time on the balance payable, but we're going to capture a small part of the easy ones as well. I'm going to erase, let's say, can I erase this one right here, this small part? Okay. I want to try to keep as much up there as possible because we can kind of maybe refer to it if we need some help. So on this one right here, let's look at this problem right here. And we have a scenario where you're going to be both the owner and the purchaser, okay? So remember, in general, we're going to always be the owner of everything unless it's said differently. This is one of those, so we can get the full effect, okay? So in performing accounting services for small business, you encounter the following situations. This company enters sales and taxes separately in their cash register, okay? On April the 10th, the register totals sales of this amount and sales taxes of this amount. What does this mean, okay? Now, let's break this journal entry down here. April 10th. Now, the company is Wildmouse Company right here, and they sell things. So, just in general, before we even start talking about stuff, can everybody see if I write right here? Can you see that? Okay. So, when we're talking about making a sale, we make a sale, we're going to obviously receive some what? Some cash, right? It may be receivable, but for this example, we're going to always receive cash. Now, I'm not going to write the amounts here. I just want to make this link, okay? And whenever I sell something, I've completed my obligation to sell, so I can record some revenues. Everybody agrees, right? All right, so sales revenue. Now, we're going to treat this as one big thing. We're going to say that they went into the business and they have revenues of $27,500. I'm going to phase this in. Part of the cash I receive is going to be, is it $27,500? Yes, $27,500. This is still a debit, okay? So my sales revenue is $27,500. Let me move this up a little bit further. I want to show this as a breakdown, okay? Now, what you did is that you bought this car or you bought this machine that cost $27,500. Now, this is to make us think what's going on. That was the sticker price for that car, that machine, right? Did you only give the store $27,500? Is that all that you gave them? No, because you have to pay what? Sales tax. So the reason this is broken out is because the store, they had to capture that, but they also had to capture the related liability, and that would be sales tax payable. And so that sales tax payable is, they don't give us a percentage here. I'll show you how to compute the percentage. The sales tax payable is $1,375. But guess what? They had to collect that as well. $1,375. So now, they collected this, which is what you paid, and they're going to keep this. Now, this is their money to invest in their business. This is theirs, okay? But also they had to collect this part that they will actually submit. And so now, we see that the total that was collected equals the 28,875. Okay, this should be a debit. 28,875. Okay, so my debit is for cash of the total amount that my company collected. Right, our company collected this. Collected the part we keep in green, and we collected the part in red. Erase this red one because it's not relevant here. Okay. All right. So you see how it kind of breaks down from an accounting standpoint. We know this now, but it's just about just putting it in our books. Does that make sense in terms of what we have there? Okay. Now, this entry is from the store's perspective. Okay. This is from the person that's selling it. So we will act as if we're the person that's selling it. Now, this doesn't ask you about the sales tax percentage, but we can always go back and compute that by simply looking at the fact that we had a total of 28,875. So 28,875. Well, excuse me. I have taxes of $1,375. So $1,375. $1,375 divided by 28,875. And so my sales tax percentage was about 4.8%. Okay, so that's just say if they ask you, well, what was the percentage? Or even you want to know. You may say, hold up, this doesn't look right. I thought this was what it was. They say, oh, well, the sales tax was 2%. And you do your computation. No, that's more like 4.5%. Something's wrong here. So you want to be able to go back and recompute things, which is why we have that right there. Okay? Everybody okay with that? There. That's not a part of this particular part, but when we look at the next part, we're going to actually have to go in and compute it, okay? So in the next situation, Carla Vista, they do not total this word, they do not separate sales and sales taxes. So we see that they have collected $19,610, which includes the sales tax. So in the first example, they gave us a little bit more information. In this example, we're going to have to make our own up, okay? So, can I erase these numbers right here? All right. And this may happen to you. This may happen in your business. Now, so I think you'll probably be even if you don't want to be your own accountant, it's probably good to at least look over it closely, especially if you get somebody new. So, your employees come in, and by the way, they're not trying to do bad. They just don't know everything, okay? They don't know what you know. They haven't had the class. So, they come in and they say, hey, we sold $19,610 a day. We did a good job. Okay, so this is what they say. They say that we sold, and I'll put it over here. I'm not going to put it right here yet. I'm going to come back in a second. They say that we sold 19,000. How much I said it was? $630. This is what they said. We sold that amount. Hey, we did good today. And you say, yes, sir, yes, man, we did good today. But you remember, we have to pay taxes, right? So now you have to go through the computation and show them that we can't keep all this right here. How do we do that? You would say, well, look, the sales tax is usually 6%. So remember, for every dollar that we sell, we owe taxes on that because it's just the right thing to do. So how do we do that? What you have to do is you have to go in and you look at your amount that you got, which is $19,610. And you multiply that by 6%. If you put your calculator, you put in 0.06 in your calculator. You multiply that, and you say, yes, we did good. But when I did times 6%, I found that I owe $1,166.60, okay? So I'm not sure if they round in here, so right now I'm just going to put 77. We'll see the rounding in a second, but you're going to show like this right here. This is the way I would show them. Now, I know this is right here. You have to tell them that, yes, we're going to record cash. But you have to tell them that, look, we cannot record the entire amount as revenue. We can't do that because we have to pay our taxes. So we have to not put this amount here. First of all, we take our taxes, which is a liability. Don't lose sight of what we're doing. Long-term liability of $1,177. We may have to adjust that for rounding, but $1,177. And then everything left over after I subtract my 19,610 minus 1177. Look, it looks like we'll have 84.43 for our actual revenues, okay? $84.33. Let's see. Let's see if they're rounding. I put the wrong number in overall, okay? This should be 1110, okay? So 1177 is a little bit rounding, but we see it because, let's go back and do that computation there. Oh, I didn't put an extra zero in, okay? So 19,610 times 0.06. I'm coming up with 1177, okay? My round is going to be a little bit different than what they have here. So this amount here, 1110, and they just round all the way down there, so 1110, okay? And that's a result of the 6% that I paid out. This, I missed a whole number right there, should be 18,500, okay? 18,500. I forgot to put my one here. 18,500. Now I can record all of my revenues. So once again, this is made up by the 18,500 plus what I have to pay back out to the government, 1110. Okay, and that's what equals my $19,610. Okay. Is everybody okay with that there? Any questions so far? So the biggest thing here is to understand that even though we have a sale, there's a component that is equity. So this is equity. There's a component that is a liability. And of course, we increased our assets. So even though we're not really focused on that side over there, we're still going to have to deal with it from time to time. And that's why it's important that we always remember we can come back and check everything to see if it equals in terms of debits and credits. If it's off a little bit, we'll kind of know where to go. But most of the time, like say I missed a number, we'll know that 10,000 off, oh, like literally 10,000 on the dot, it's something wrong with that. I missed a number, okay? That's going to be the easy side, but I can catch it if I look at my debits and credits, make sure they're equal, okay? Everybody good so far? All right. Keep going on there. Let's look at a different section here. All right. Now let's go to, you know how to compute your sales tax. You simply take what you have and multiply it by. So that's just another example there. If you have, just an example, if you have 9450 and you have a tax percentage of 5%, then what do I put in my computer? I put in 9450 times 0.05, the zero will be there, and I multiply it. And so 9450 times 0.05 will give me $472, okay? So $472 is what I would have right there, multiplying it by 0.05, okay? So make sure that you know how to compute the actual sales tax itself, okay? Make sure you know how to compute the actual percentage itself, all right? When it comes to our check stubs, okay, if you have one, that's okay. If you don't, we'll just kind of go through this right here, all right? So what we basically have is an expense, okay? So I'm just going to read this here. This person here has an hourly rate of $18. Let me go back to it. I'm sorry. Yeah, an hourly rate of $18, and they receive $27 in excess of work for 40 hours. That's basically time and a half. How they get that? $18 times 1.5 is 1.5 will give you $27. So basically, $18 an hour and $27 for every hour over 40. Okay. Now, during the pay period, this person worked 46 hours. The federal income tax withholding is $91, and there are no extra deductions. Assume there's going to be FICA 65. Now, you are this person's employer. You're this person's employer now. So you have to prepare the journal entries for this person. In general, the general part, now I'm going to come up here a little bit. I'm going to erase this up. That's okay with you? All right. Because I'm going to use a little space, okay? Remember, you are the employer. And the thing that we have there, I'm pretty sure everybody knows that they're going to get 1.5 times for overtime, right? So I don't have to tell you that, you know that. In general, if you are the employer, then it's an expense to you. Part of it is this is an expense that you're going to have to pay. So you have a salaries expense. Let's start right here. Salaries expense. Let me change the color here. Salaries expense is actually, even though it's has salaries in it, that's part of equity. I have to put it there because I want to match my colors, okay? So that is actually a reduction of your equity, okay? Salaries expense is a reduction of equity. Why? Because remember, we had revenues minus expenses equals net income. We put that into our retained earnings and retained earnings in here. So saying that salaries expense reduces equity, that's why. Just going back to that concept we had a little earlier. Now, I'm going to skip down, but let me make a difference. Every time you collect that money at first, you do not automatically pay it out. So the journal entry up front is not an automatic payout, okay? You're going to pay it out later, okay? Not all at one time. So instead of putting this cash here, we're going to come back to that cash in just a little bit. It does not go with that component up there. Instead, since you're not going to pay it all out, then you have a what? Do you have an asset? Do you have an equity? That means we have a what? A liability, because we're going to pay it later. So this liability, we're going to have a payable, and so this payable is going to match here, okay? And our payables are going to go as part of our liabilities. Now, each of these individual ones, you have to make a journal entry. So you have FICA, and they tell you right here that that amount is 7.65%. We'll come back to that when we calculate the percentage. We have the federal income taxes payable, and we have salaries payable. Okay, so let's see what we have. Your federal income taxes payable is given to you. It's $91. Usually, you're not going to have to compute. Now, excuse me. When I'm saying it's given to you, that's not the number every time. Okay, that's based on what is being done. So in this case, that's given to you. $91. Okay, and this will be a payable, specifically called federal income tax payable. Okay. So it's a payable, make sure we know that for liability, and it's a federal FI income T tax payable, okay? So this is what we have here, okay? $91. we also have given to us our FICA amount. Now, the way that you do that is $7.65. So that's one that we have to compute. And when we compute it, it's going to come out to be $67.47. $67.47. Okay, now, is that a payable? Are we paying it right now? No, we're paying it later. So we're not paying out cash, but we're paying this out later on. And so this is going to be, you'll see it this way. And you will see all these actually on your check stub, okay? You're going to see that payable, okay? And that was $67.47. We're not paying it now. $67.47. Okay? And so now, the remainder of that, keep it in mind, this person made $882. How did this person make $882? Remember, they're getting $18 an hour, right? So 18 times 40 will give us $720. 18 times 40 will give us $720. So this is actually $720. That's $18 an hour times 40 hours is going to give us $720. I'm showing, similar to earlier, the expense makes up two different parts. Right? And then they're getting paid time and a half, $27 for 6 hours. So 27 times 6 will give you $162. This is my regular pay plus overtime pay. That is $27. $27 times 6 hours gives you $162. And when I add those together, I get $882. So my salary's expense is going to equal $882. Okay? So we're clear on how we get this part right here. This is, I want to make sure that we understand that this is all a part of how I computed to get my $882. Okay? So sometimes it may be given to you broken down. So if it's broken down, do one section, do the other section, add them together, and that's your amount. So let's check it out. We have $882, salaries expense, right? We know that $91 is going to, that's how much, matter of fact, that's what you call your gross income, okay? That's what you signed up for, your gross income. You have that. Then you have $91 that you, employer, are going to have to pay for federal income taxes payable. Then you're going to have to pay $67.47. How much is your employer actually going to get in their hands? The difference between that, right? Think about our checks. That's where it looks, right? We get less than what we signed up for. So $723.53 is the amount that actually goes to the salary payable. $723.53. This is how much the person gets in their hands, okay? So does that kind of help you out in terms of what's going on, how they come up with that there? Okay. And like I say, this is a decision you have to make. Give me a business you want to go into. If it's none, that's fine. Anybody have a business you want to go into? Nobody? No, I hope this didn't change y'all mind and make you don't want to do your own business, right? But if it did, let's say this right here. Do this though, seriously. You may have friends that go into business, right? And here's a decision that this kind of helps you to make. This is a lot of work, if you want to say that, right? It's a difference between hiring a contractor and hiring an employee. If you have an employee, then you pretty much tell the employee what to do. Not in a mean way, but you know, they live by your rules, okay? If you have a contractor, Obviously, you have to do it to your liking, but they are bound by their own rules, meaning that you don't exert that type of influence. If you have an employee, you have to do all of this, right? And then you have to come back and pay it out. You have to come and pay out the actual amount to the person. So you have another journal entry you have to come in. Salary is what? Payable. I'm going to reverse that part right there. Salary is payable. For the part that goes to the employee, 723.53. Yeah, 723.53. And make another entry. So you see we have two entries we need. 723.53. Two entries we need. With two entries we make this entry to record all of this, which we will have another journal entry later for that, but not for this part. And you have to make this. That's if that's your employee. But with the contractor, you don't do all that. Contractor, you just simply come in. You have, people call it different things. So you may have contract labor. It may not be called expense, but whatever you call it in your company, contract labor, in cash for whatever it is. You don't have to worry about all that computation. You don't have to worry about all that paperwork. You don't have to worry about forgetting something. And you issue them at 1099 and you finish with it. So this is if you have an employee. This is if you have a contract. Okay? So that's the difference right there. That's not part of it, but just a decision that you may want to make going early on. You know, do you want to have somebody to help you out, or do you want to have somebody to work for you? You're going to pay both of them, so I hate to say help. Do you want to have a person that you tell them exactly what to do, or do you want them to make their own decisions? And then this may actually could possibly reduce your liability. So if you do have a contract of some sort, make sure they have the insurance that they need so that you won't be held liable. Okay, so those are the things that you want to make sure of. Okay. Any questions on that part? So does this kind of help us see where we're going with our liabilities here? This in general is everything. The biggest thing we'll talk about that you may want to focus on before we come back next time is issuing a bond. Okay, now we did the general entry or the easy entry, which is issuing it at a discount. I mean, issuing it at par. Next time, we're going to look at issuing a bond at a discount, issuing a bond at premium, and then repaying the bond. Two different issues you can have there. So we're going to look at next time. And so what I would urge you to do is to look at that part, if nothing else, this time, look at that part of the PowerPoint, because it's going to make it very clear with some of the things we're going to be doing, so that the journal entries could be, because those, we've never seen those kind of journal entries before. Even when I took the next class, which is the higher level class, this wasn't easy to me because it's not something that we even see. We know about this right here, you know, paychecks and stuff, and we know about borrowing money, but we don't know about, I didn't know about bonds. So if bonds is something that's totally new to you, look at the PowerPoints before we come in, so that, you know, not for a full understanding, but just to kind of break the ice, and it won't be as difficult to get, okay? Any questions? Well, I will see you on Wednesday.